go again. Nearly 14 years after the last housing bubble burst, inflated property values are about to face a brutal drop as rising mortgage rates and worsening affordability cool off the boom that sent home prices up by a staggering 34% over the past 2 years. According to the latest estimates, at least half of that gain can be lost this year as changing market conditions inevitably trigger a national home price correction. Homeowners are getting increasingly burdened by their loan payments, while first-time buyers simply can't enter the market anymore. At this point, over 90% of the market is extremely overvalued, and experts are telling us that even a 10% crash would throw the U.S. economy into disarray. Before exposing some real concerning numbers with you today, please support us by leaving a thumbs up in this video and subscribing to our channel. Does anyone here still remember what happened in 2008? That was when America suffered the most significant and most painful financial crisis since the turn of the century. Back then, the U.S. recorded the worst financial losses since the stock market crash of 1929. Millions lost their jobs and consequently defaulted on their mortgages, faced foreclosure, and lost their homes. Trillions of dollars of lifetime savings and wealth were simply wiped out. Banks and investment firms that seemed too big to fail failed fast and hard, but the worst thing is, they seem to have failed to learn from their mistakes. The collapse was fueled by government policies that intentionally inflated a housing bubble year after year, much like the ones that have been put into place since the onset of the health crisis. In 2008, very few people saw the bursting of the bubble coming. Now, in 2022, very few people believe that a housing crash is possible. In fact, very few people admit that the housing market is indeed in a bubble. Right after the previous housing bubble popped, the carnage spread all over the nation, and the impacts were felt by virtually everyone. Now there are many of the same flashing signs of a housing bubble, and once again nobody is paying attention. The ongoing housing boom pushed home prices up 34% in a span of 24 months. If that looks normal to you, maybe you should look again. According to the Moody's Analytics proprietary analysis of U.S. housing markets, local income levels cannot support local home prices in 96% of housing markets across the country. This means that most local housing markets in the United States are currently at risk of a home price correction. Of the 392 metropolitan statistical areas the firm looked at, 376 are extremely overvalued. Among these 392 markets, 149 are overvalued by at least 25%, with the most overvalued being Boise, where home prices are 73% above what fundamentals would support. Moody's Analytics chief economist Mark Zandi notes that regional housing markets can't remain overvalued to this degree, and argues that such absurd prices should be a drag on future home price growth. On top of that, over the past 2 months, the average 30-year fixed mortgage rate has spiked from 3.11% to 5.48%. That huge increase in mortgage rates is definitely a shock to the red-hot housing market. Zandi reveals that a price reversal has begun, and in the coming months that cooling should only intensify. He also predicts that by this time next year, year-over-year home price growth will be at zero. Considering today's extremely inflated prices, a 10% crash in the most overvalued markets would be more than enough to push the U.S. economy over the edge. Worse than that, it could set off a national home price correction that would hamper the market's growth for years, if not decades. However, The firm's estimates indicate that prices will likely plunge by 15%, reversing the past 2 years' gains by more than 50%. Moody's Analytics isn't the only firm sounding the alarm about the current housing bubble. CoreLogic, a real estate research company based in California, released an analysis last month that found that 65% of regional housing markets are disconnected from fundamentals. Moreover, research conducted by Black Knight, a mortgage technology and data provider, found that the typical American household has to spend 31% of its monthly income to make a mortgage payment on the average priced U.S. home, marking the highest reading of Black Knight's mortgage payment to income ratio since 2007. As a comparison, back in December, the typical American household would have to spend 24% of its monthly income to make a mortgage payment on the average priced U.S. home. Right now, the average mortgage payment is $1,800 a month, which is 70% higher than before the health crisis hit. The only other time home payments were as high as today was in 2007, right on the eve of the 2008 bubble burst and the great financial crisis. Over the past year alone, home prices jumped by almost 20%, 19.9% to be exact. Even though that can be good for homeowners as their home equity surges, these gravity-defying home prices are a nightmare for home buyers, particularly first-time buyers. In the years leading to the 2008 housing bust, the biggest 12-month jump was 14.5%. Does all of that still look normal to you? Most of the people who deny the existence of a housing bubble and ignore the risks of a housing crash argue that today's market is different. So, a crisis like 2008's won't happen. Well, let's see about that. Today, loan-to-income levels are rising just as it happened back then. This imbalance makes defaults more likely. When a correction occurs and home prices drop, borrowers will start to be pushed underwater with unpaid loans more outstanding than the house's value. They will walk away as millions of borrowers did in 2008 and 2009, explains financial and economic writer Stephen Moore. Congress, the Fed, and housing agencies such as Fannie Mae have continuously pumped air into the bubble. The Fed has not only artificially held interest rates too low for too long as part of its stimulus strategy, but also encouraged home loans by purchasing $2.7 trillion of mortgage-backed securities and held them on its balance sheet. That's precisely what it did in the early 2000s, Moore adds. At the same time, Congress has passed hundreds of billions of dollars for taxpayer-funded rental and mortgage assistance, further propping up the bubble. Meanwhile, Fannie Mae, the federal guarantor of trillions of dollars of mortgages, has started insuring mortgages of more than $1 million. We have to remember that this program was supposed to help lower income and first-time home buyers. Now, millionaires are getting subsidized loans thanks to the tremendous power of the housing lobby made up of realtors, mortgage bankers, and home builders, Moore wrote. Another feature of a bubble is speculation, and the fact that federal agencies are insuring million-dollar mortgages for investors and wealthy buyers proves that today's conditions are not different than they were in 2008. Needless to say, when this bubble pops, everyone will get hurt. Home ownership rates will crater again, which is the opposite of the direct result from all of these government programs. These are the laws of unintended consequences that Congress never learns, Moore emphasizes. Housing bubble collapses across history have also seen other three main elements: a slowing economy, higher rates, and lower demand. We can put a check mark on the first two elements, and the third is now unfolding. New data released this week shows that U.S. new home sales have fallen to a 4-month low, having declined every month in 2022, and that's a far cry from their early 2021 heyday. This persistent decline in home sales can disrupt the market by sparking a massive downshift in home prices, feeding a cycle of evaporating demand and plummeting home values. That's what legendary investor Jeremy Grantham sees happening this year. As mortgage rates continue to rise, the financial expert says that a property crash right now would be much more dangerous for the economy than a drop in stocks. Grantham said in an interview with Bloomberg, the year 2000 showed you can just about skate through a stock market event. But Japan in 2008 showed you can't skate through a housing crisis, he added. In 1991, when property prices peaked and then crashed in Japan, they triggered a crisis that's still weighing on Japan's economy. In the interview, Grantham also warned that inflation will soon lead the housing market to a day of reckoning. He is one of the few who argues that U.S. financial markets are in a super bubble. But on top of the worrying signs we can see on stock markets, Grantham thinks housing markets look particularly dangerous. Many mainstream media articles actually acknowledge that the market is slowing down, but insist that a crash is not likely. For those who've seen it happening before, that sentiment puts them on crash alert. When the housing market peaks, it's like a runaway freight train without brakes, but when it runs out of power, things tend to derail very quickly. From one day to the other, multiple offer listings become for sale signs that sit followed by price cuts. Then, rather than chasing prices higher, prospective buyers wait to see how low the price will go, as highlighted by Investment Research Dynamics in a recent report. The difference between the housing market of March 2020 and the housing market of March 2022 is gigantic. In a matter of 2 years, we've flipped from a normal housing market into one that is historically overpriced. That's not healthy or sustainable at all. The latest Pulse reading is already showing signs of a major shift. The number of home sellers who dropped their asking price shot up to a 6-month high of 15% during a 4-week period ending on May 1st, up from 9% a year earlier, according to Redfin's latest report released Friday. Given that most Americans live paycheck to paycheck and are already financially squeezed due to prices rising faster than paychecks, we can expect the downward trend for prices to accelerate from now on. The thing about bubbles is that they can only grow to a certain point before they break, and it's more than clear that we're reaching a breaking point.